All right, welcome back everyone. In today's video, we'll be covering the monstrous earnings by Palantir in detail, and boy was it a monstrous quarter. Now the stock initially up the day after the earnings, the candle that we can see here, and then it just dumped with the rest of software and some fintech yesterday, and currently trading at $139 as I'm recording this on Thursday, February the 5th, down 11.6% yesterday. However, if we look here, for the first time in a long time, Palantir is severely undervalued. Fair intrinsic value of $204 currently, because this quarter changed everything about Palantir, and we'll get into why. Also trying to grow into that multiple, still very, very expensive. 80 times price to sales, 220 times price to earnings, despite, trading down severely. But pricing is not value. So let's get into the charts here. Let's start from the top. Look at top line revenue, which grew 70% for the quarter, and annually it grew 56%. Now that on its own is very, very impressive. If we look at this acceleration here, once AIP launched in Q2 of 2023, it's just been up and up and up every single quarter for 2.5 years. Has been going up and up and up every single quarter. Not a single quarter showed deceleration, and given Palantir's guidance, this acceleration will continue. And there's more evidence to that than just Palantir's guidance. You can also see it in the numbers. We'll get into that shortly here. But the crown jewel in terms of growth is, of course, US commercial revenue, which grew 137% in Q4 and annually 109%. Of course, very, very impressive. And the main beneficiary of, the AIP launch, AIP and the boot camps associated with it are concentrated in the US, which is why US commercial is gaining so much traction. But there are some interesting dynamics that we'll get into shortly as well. US government grew 66%, and people have been sleeping on US government for the longest time. And if you've been following the channel or my research, I've been very, very bullish on the government because it is one of the stickiest customer that you can have. And given recent commentary by management, they're getting more done in 1 year under the Trump administration than they managed to do throughout the whole Biden administration, the whole full year, a 4-year period. So of course this will also continue to accelerate annually, 55%. Now international commercial not doing so well, but reached a new all-time high after it's been trading sideways ever since they went public. We all know that Europe is not a very good market for Palantir or many other American companies. It's not a mere Palantir problem. It is a European problem. Very anti-business, very anti-tech scene, over-regulated. Europe has some problems. This will come around. When that is, we will see. But they can only drag and suffer GDP-wise for so long before something changes, and that change will come. I don't know when, but if they can grow 70% without international commercial growing at all, then God knows what it'll look like when this segment also starts performing. Now, while international commercial is not really growing, international government actually are starting to adopt a lot of Palantir. So 43% for the quarter, 66% last quarter, but annually grew 47%. That's a lot of growth. It pales in comparison to US commercial, but so does pretty much everything in the market. 47% year-over-year growth is, of course, very, very strong for international government. So the government side of things is starting to pick up pace. Commercial, not so much yet, but the governments outside of the US are starting to adopt more and more Palantir. Now, what's so impressive is not the mere, top line number, which is, 56%, or 70% annually for the quarter, year over year for the quarter, sorry. It's the manner of how they got that growth. So if we go over to the cohort growth chart here, so this shows us, how much of the growth is from current customers, existing customers, meaning they've been with Palantir for a year or longer, and how much is from new customers. And this shows us the real scalability of Palantir. The current customers are contributing a majority of the growth, which is a rare thing to see, when you're analyzing companies. Typically, you have to, put a lot of money into sales and marketing to grow, more customers. And from more customers, that's, the bulk of your growth. But Palantir, actually 39 out of that 70%, so a majority, came from existing customers scaling up, their use of Palantir solutions. And that has really been the case, ever since AIP took a foothold here, somewhere around, Q1 of 2024. And since then, existing customers have contributed a majority of the growth. So even, this past year, even if Palantir acquired no new customers, 39%, they would still grow 39% with no new customers at all, just, from existing customers. And that really goes to show that, once Palantir gets a foot through the door and starts delivering value to your business, you really want more Palantir. And that is, in essence, infinitely scalable. I mentioned this before, but let's say hypothetically that you're paying, 10 million. Sounds very expensive, right? 10 million annually for software. But if that software is making you 100 million, for that year, then you're happily paying that 10 million. Or, if you scale that up, let's say that you're paying 1 billion per year, but you're making 5 or 10 billion from using that software, you'll happily be paying that. Like, it has no ceiling in theory. And the more parts of your business that adopt Palantir, the more revenue Palantir can recognize, since AIP seems to be usage-based. So this dynamic is very, very strong. This is what you want to see. People that are doubting, like, how sustainable is the growth for Palantir? Well, very, very sustainable when a majority is coming from, scaling and not mere, customer acquisition. So that's very, very interesting. And what ties into that is, the top 20 customers. The top 20 customers account for 42% of all revenues. 42%. So this golden line here, we can put some quick labels on it. Data labels above. So 42% here of all revenue is just 20 customers. Out of 950 some customers, 20 of those account for 42% of revenues. Now, what's interesting is that those 42 customers are the ones that are growing the fastest. So this is the fastest growing cohort. So if we do the same, 1 second here, data labels above, 45% came from the top 20 customers. So the ones that are using Palantir the most, they're already paying, massive sums of revenue to Palantir. They're also the ones that can't get enough of Palantir and just keep scaling up and up and up and up. So that is a very, very interesting dynamic, because typically you don't want customer concentration. That creates a risk. If a large customer leaves you, a large chunk of your revenue will also disappear simultaneously. But what's happening here with Palantir is that your most loyal and your largest customers are also the ones that are growing the fastest. So that is just further evidence of the scalability of Palantir. Very, very impressive stuff. And a big shift happened this quarter. And that is the average revenue per customer came up by a lot. So if we look here, Ever since we could record average revenue per customer, it has been sliding downwards, and that makes sense, right? As you scale your customer base, this figure naturally comes down. But if we look here at Q4 of 2025, it had a massive jump to levels that we've not seen for 3 years, more than 3 years. And that really signals that Palantir is able to acquire, large contracts now. And, given the commentary on the earnings call, it seems that Palantir has more inbound volume than they can deal with. And they're really choosing, who they are working with. And they seem to be prioritizing, and rightfully so, the largest contracts, which makes perfect sense. When you have limited resources to allocate, you want to go for the big ones, and that's really what's happening here. So average revenue per customer came up a lot. Now, if we go to the actual customer growth, the net addition for Q4 is actually down compared to more than a year ago. It is the lowest figure in over a year, but still the revenue growth was massive. That just goes to show that Palantir really has decided to focus on those large contracts. Now, this will change once AI FDEs, come into play, and we will talk about that shortly. But if we look here at US commercial, 41 of those 43 customers were US commercial of overall net additions. And if we go to the government, they added 5. And non-US commercial actually had a net outflow of 3. You can't really see the 3 here. I can pull it down a bit. One sec. There we go. So -3 for the quarter. So international customers actually had a net outflow. And it makes sense because they're concentrating their efforts into, the US currently. But if we actually look here at the customer acquisition cost, we see something more interesting. So, of course, since they more or less have not really fixed operating costs, but, operating costs are, more or less static. They're growing, slightly every quarter, but nowhere near, what the revenue is growing. Since they actually acquired so few customers, the customer acquisition cost per customer went up a lot. But a more important metric is how long does it take for those customers to pay themselves back. And it is 3 months, which is the lowest figure that they've had ever since they went public. Even during this period when they basically bought revenue by, forming contracts with SPACs, still 3 months. So within the same period, customers are paying themselves back from being acquired. If you net out the sales and marketing costs, which really goes to show that, as I mentioned before, they're really targeting those really large customers. So if we look here at contract balances, we will see further evidence of that. So let's first look at total contract value. Total contract value for the quarter grew 139%, and that is massive increase here. These prior quarters they had higher numbers, 143 and 155, but the base that Q4 is comped against is a lot tougher. So if you look here, Q4 of 2024 is basically more than $1 billion higher than Q2 and Q3, which these periods were comped against. So on an annual basis, 127% increase in total contract value. And what that shows you is, okay, during the year, what's the value of the contracts that we signed? And, it is now in excess of 10 billion. It grew massively, 127%. And on the quarter, I think it was 4.6 billion. Massive increase. Now, the interesting thing is that these contracts can be broken down, in deal sizes. So if we look here at the deal size breakdown, you can see that Q4 actually had a lot less deals. So this is, deals of at least 1 million, and then it goes in cohorts of 1 to 5, at least 10, and then 5 to 10. So basically, this segment here, which is at least 10 million, it could be 100 million, 500 million, like there's no cap. Only these other two, 1 to 5 and 5 to 10, have caps. So despite signing a lot less deals, they managed to close massively larger amounts of total contract value. So that is really all the evidence you need for the quarter that yes, Palantir is focusing on those large major clients. And when you sign a major client within a sector or industry, everyone adjacent to them or below them tend to want to copy them and also acquire Palantir. So if the industry leader is using Palantir, it also makes sense for everyone else within the same industry to be like, oh, they're using Palantir. We should probably also be using Palantir, especially when they show the kind of value that they are generating by using Palantir. Next, another massive jump is remaining performance obligations. So what this shows us is basically how much revenue is to be recognized, like guaranteed. So this is, the full amount of RPO is guaranteed revenue as opposed to remaining deal value, which we will look at shortly. RPO is guaranteed, and it is divided into current, so over the next 12 months, and non-current. And we can see here that a lot of that RPO is non-current. However, this current amount, even if Palantir shut down its business today, just from current RPO, they would record more from the RPO, which is guaranteed, than they did the whole of last year in US commercial. So the current RPO exceeds the full US commercial revenue from the prior quarter. So that just goes to show you how sustainable the growth is, when the contract balances are looking like this. Especially considering that RPO is basically all commercial revenue. Due to the nature of government deals, they typically don't have fixed amounts of for how long Palantir will deliver services, and for the deal size, it could increase, it could decrease. Due to the nature of those contracts, they don't qualify for RPO. So basically, this is a proxy for commercial revenue. And we know that most revenue on the commercial side that is being brought in and signed is, US commercial, because international is not really growing. So this very strong signal, and from 2.6 billion to 4.2 billion in a single quarter. That is a massive increase. Now, for the next one, remaining deal value grew 106% for Q4. Now, also comfortably exceeding, that 10 billion mark. The thing with remaining deal value is that it also includes options in the contracts, and those options are not guaranteed. Typically, they tend to be, honored and recognized, but there's no guarantee of that. So while RPO is, guaranteed revenue, remaining deal value does include options which are not guaranteed. So keep that in mind. So for the on an annual basis, grew 106%, and just look at if you want to see what the beginning of an S-curve looks like, it's this, pretty much stuck beneath, that 4 billion mark for 4 years in a row from 2020 to 2023, jumped up massively last year, and now, an exponential increase year over year, 106%, massive. And let me keep this short. The remaining deal value for US commercial grew 145%. Massive. On the quarter, 145%, 196% last year, against an easier comp. But this also, you can see this upward stagger, really impressive. So everything that we're seeing here in contract balances tells you that revenue growth, is nowhere near stopping. This is just getting started. Let's go to, we can't look at revenue per employee because the employee number is not out. It's in the 10Q. But the rule of 40, which this is basically telling us the quality of Palantir's growth. Now, any company in theory could borrow a lot of money, burn that money, to acquire revenue. It could be customers, it could be through M&A, it could be, various reasons, but you have to measure the quality of growth. So typically within the SaaS world, we use something called the rule of 40 score that you'll hear analysts and Palantir and media outlets talk about. So what the rule of 40 is, that when you combine the profitability and the growth rates, they should equal 40 to signal that the growth is of high quality, sustainable, and since it's not a GAAP number, it is up to the companies themselves to define their rule of 40 score, which they think best represents their business. And then, you at home, you could also define your rule of 40 for Palantir however you want. The way Palantir does it is they use year-over-year revenue growth for their growth. And for their profitability metric, they use adjusted operating margins. And that operating margin is adjusted for SBC expenses. And I believe taxes related to that, which is basically a proxy for free cash flow for Palantir. Since free cash flow, the cash recognition tends to be, concentrated into specific quarters for Palantir. So typically, by the end of the year is when, contract renewals and, payments and stuff are being made. So it is not a good way to gauge, how the profitability is expanding, since it is kind of volatile. I'll show you just quickly what free cash flow looks like. You can see that the margins here are just jumping up and down because it varies quarter to quarter. But if we look here at the rule of 40 score, the adjusted operating margins makes a lot of sense because it is operating margins, and then those operating expenses include stock-based compensation, which is a non-cash expense. So that is added back just like in free cash flow. So that's why they use that proxy. And they reached 127. So that's basically more than 3x what the benchmark is for, high quality growth. And that is just been increasing every single quarter since AIP launched here in Q2 of 2023. Just been going up and up and up and up. And to be honest, given Palantir's operating leverage, which we will look at next, and given Palantir's growth and guidance, and we just looked at the contract balances, it seems that growth is just going to keep accelerating, and the margins will keep expanding. So this score will keep expanding as well, and this is just insane. You will not find a single company publicly traded that is exhibiting the same amount of growth with the same amount of margin expansion. It is just insane. So if you go and look here at operating leverage, you can see what that looks like. So here we have research and development costs. We know that Palantir is, a tech company, a software company. We know that they have the best engineering talent in the world. But if you look here at R&D costs, ever since 2019, so, a 6-year period plus, basically 7 years here, it is relatively static. It's growing, slightly, ever so slightly. But look at what revenue is doing. It is going up massively. And that is why Palantir is able to, grow that margin by so much. And this is what really makes the company special, is that they have this immense operating leverage that, it is very, very rare to see something like this where, operating expenses are relatively fixed, but, the growth is explosive in nature. Like, this is simply amazing. So if we go and look here at operating and income margins, we can see that this margin expansion, ever since they became profitable, it has been going up and up and up and up, and now exceeding 40% in Q4 of 2025. Now, you might be wondering, well, how come that net income margins are higher than operating margins, because typically, after those operating margins, you have further expenses like taxes and stuff. That is because they have interest. They have a lot of treasuries that are yielding them cash. So that's why you see this dynamic where net income is higher than the operating margins. But really, these dips you see here are, in Q4 of 2024, they recognized a one-time SPC expense, which pushed the margins down. But then, back to business, now exceeding 40%. And if you ask me, Emir, what's the ceiling for the operating margins? And I couldn't tell you, because as we looked at, this operating leverage chart, this could, extend massively further up. The operating margin is already at the level of the highest quality businesses in the world, massive moats, pricing power, all of that. Palantir has already reached that. And what's scary about it is that, they're nowhere near done. It's not like it's going to cap off here at, it's not like it's going to cap here at 40%. It's going to keep expanding. And no one really knows where that ends, because they have such operating leverage. Now, if we look at interest income, you can see that for a couple of periods here, interest income was a majority of Palantir's profits, and they received a lot of negative comments from investors, where they were worried that, well, is Palantir really profitable? A majority of the net income is from interest. Well, yeah, they are really profitable, as you can see here. So the black bar is net income without the interest income, and then you have the interest income in gold here. And you can see that, yes, it is making up a smaller and smaller percentage of overall net income, but it's still a nice boost, because they have no debt. They have a lot of cash on hand. Why not use it and put it in treasuries while, the rates are so elevated? Like, it makes perfect sense. Now, once the rates drop, what will they be doing with that cash? Well, that remains to be seen. That's a very, very interesting question that we can discuss, for the length of this video, but we're not going to get into that today. We're just looking at what a massive quarter Q4 was. And now if we look at adjusted free cash flow on an annual basis, the margins are expanding massively as well here. So 44% last year, already very, very strong adjusted free cash flow margins, now reached 51%. And if we look at, let's see here, another pain point, well, you can first look at the, cash balance. Now up to 7.2 billion, up from 5.2 billion last year. They're generating a lot of cash. They have no debt. Then, they put it to work, farming yield for them. Makes perfect sense. What I wanted to talk about is the stock-based compensation and outstanding shares. So a common thing I hear in regards to Palantir is this notion that Palantir is diluting shareholders, massively. Well, let's see if that's true. In Q4 of 2025, outstanding shares increased by 1.8% year over year. Is that massive dilution to you? 1.8%. Now, it is true that there was a period in time where Palantir was diluting their shareholders by a lot. But now, since they're generating such massive amounts of cash, there's basically, they are debt free. There's no need, to raise capital through, equity offerings or anything like that. This has tapered off aggressively ever since they went public. Now they do still have stock-based compensation and stuff like that will, increase the float. But 1.8%, is that really something to get hung up over? Now, I expect that to continue to drop off. There might be some periods, where it increases. Like in Q4, they had the one-off SPC expense, diluted from 5.8% to 7.2% in that quarter. But overall, the trend, very, very negative. And as far as SPC compensation, while it is increasing, as the share price is increasing as well. The overall stock-based compensation as a percentage of total revenues is at 14%. 14% is way below the SaaS industry average. So when you compare it to, Adobe, CrowdStrike, Salesforce, ServiceNow, all of these software peers, SaaS peers, the average is around, 22, 23%. Palantir is at 14% now. And just like every other trend, the trend is very, very positive because it's going down basically every single quarter. Now down to 14%. Don't be surprised if it's down even further next quarter, and so forth. So yeah, I mean, overall for the quarter, we saw massive growth, very healthy growth where they are expanding margins. A majority of the growth is coming from existing customers, which shows us that, the scalability is real. Despite, customers not growing that fast, they are concentrating their efforts into the customers that matter, basically the large customers. And that will change because, as I mentioned, Palantir is a bit, resource constrained. They can't answer the, inbound volume. It is basically implied through commentary from management. But we also know that they are working on AI FDE. So currently, adopting Palantir has a big pain point where you have to build out an ontology. Like typically a forward deployed engineer will go and assist, building out the infrastructure that will be used, for getting started with Palantir and stuff, helping contextualize the whole business with the customer. That takes a lot of time and resources, and Palantir has limited resources. Like they are not hiring excessively. Actually, they are like decreasing headcount. So once AI FDEs start to, be deployed in scale, the average customer acquisition cost will go down. The net addition of customers will likely start to explode. It will change everything for the business. So before that happens, it makes sense to focus your resources into the customers that matter. But once AI FDEs are operational, at scale, they can build out to those ontologies. They can do a lot of that work that is, very, very important, but also very, very resource heavy. So that dynamic will change massively, and God knows what revenue growth will look like at that point. Did I miss anything? Want to try to keep this as short as I can, so I kind of speed ran through this up to 32 minutes already. But yeah, unfortunately, I can't share the valuation model publicly anymore because that is for Substack paying subscribers. I have to provide them some sort of value, but I can tell you that the intrinsic value in 2 quarters basically tripled from 70 to 204. So not quite a triple, but basically tripled in 2 single quarters, because every quarter that passes with Palantir, we learn so much more things about the business. So basically in Q2, they told us that, yeah, we're gonna 10x US revenue over the next 5 years. And I'm like, oh my God. So you start to plug that into your valuation model, and that increases, intrinsic value massively. Then you start to see the margin expansion, the accelerated growth, the contract balances skyrocketing in Q3. That further brings up fair intrinsic value. And then you have a quarter like this that just, is everything on steroids, and then you further, increase the margins for future periods. You decrease the dilution rate. You see that revenues will continue to scale upwards or even accelerate from this point. They're already doing triple-digit growth, expected to, keep accelerating that. So when you put that into a valuation model, magical things start to happen. And for the first time in a long time, Palantir is undervalued, and quite substantially so given recent sell-off. So very, very attractive for me personally here to acquire more Palantir shares. And I just today wrote and published a in-depth article over on the Substack. So research.typefcapital.com. I'll put the link in the description. You can read my in-depth, a lot more in-depth than this, YouTube video if you want to get down into the details. Available over on the Substack here. And at the end of that, there is my valuation model for the company. So if you're like, oh my God, no way they are worth 200 plus. Well, look at the model and then dispute it, and we can have a discussion about it. Also, for those wondering, the Excel sheet with the built-in, charting tool, over 1,000 rows of data, basically the best data resource for Palantir available, including what Wall Street has. Like this far exceeds the Bloomberg terminal and so forth. If you want access to that, it is still on sale over at typefcapital.com. So the Substack is research.typefcapital.com. But if you want the financial models, they are still on sale. The Robinhood one and the Palantir one includes free updates basically for life. So I update these every quarter, since the 10Q is not out. I haven't updated with Q4 numbers. Once that is out, everyone can expect an update. It is currently 40% off. Even the bundle here is 40% off, and the bundle is already discounted. So if you want those Excel sheets and help support me, you can go to typefcapital.com and order those. Expect free updates. And if you want my equity research of Palantir and a lot more companies, you can go to research.typefcapital.com. So with that said, thank you so much for watching. Amazing quarter, and I will see you guys in the next video. All right, thank you so much. Bye bye.